In chapter 12, we're going to be discussing investing in stocks. We're going to focus on common stocks and preferred stocks. Although stocks have returned almost a 10% yield since the year 1926, which is more than most of your conservative investments that we talked about in chapter 11, there are periods where the stock markets have declined in value. One important point that you need to keep in mind is that the key to success with any investment program is allowing your investments to work for you over a long period of time. A long-term program allows you to ride through those rough times and enjoy the good times. So as you're getting ready to go out into the world of investing, keep remembering that you're doing this for the long haul. You're not doing it as a quick way to make money. So let's get started in chapter 2, investing in stocks. Generally, beginning investors face two concerns when they begin an investment program. First of all, they don't know where to get the information they need to evaluate potential investments. And second, they worry they don't know what they're going to do with the information when they get it. This next slide has a short video that explains the difference in common and preferred stocks. So watch that and then we'll start discussing the difference between common and preferred.
So generally more volatile than preferred stocks and certain.
So why would a corporation issue common stock? Common stock is the most basic form of corporate ownership. Stock equals equity financing, and equity financing is money received from the share of those ownership in the business that they use to start or expand businesses, to pay expenses. The money does not have to be repaid, and dividends are not mandatory. A dividend is a distribution of money, stock, or other property that the corporation pays to the stockholder. A board of directors votes on each dividend payment. Corporations will generally have an annual meeting where shareholders, that would be you if you buy a stock, you can vote in person or by proxy. A proxy would be a legal form that lists the issues to be discussed, and then you are giving your right for someone else to vote for you. Shareholders have voting rights and elect the board of directors. So why do investors purchase common stock? Even though there's a potential for loss, the simple answer is that investors generally want a larger return from the stock offers. From a psychological standpoint, many investors have trouble making the decisions to buy or sell a stock. You can get income from dividends, which would be either in the form of cash or a stock dividend. The dollar appreciation of stock value, price appreciation, and then you would have capital gain. Possible increased value from stock splits, but there's no guarantee that a stock will go up after a split. Now, one thing you want to be wary of, and it's mentioned on page 390 in our book, is called pump and dump. And this is a fraud where people go in and they make it look like the stock from a particular company is just going to take off and just explode. So the increase in value is going to go up. But once people have started buying into it, then the ones that started this through the internet, they dump all of their stock, and then of course the stocks just take a nosedive. So make sure that you research and have purchased stock that is a valuable asset to your portfolio. This is just some examples from how you can get income from dividends, dividend dates, the declaration date, the record date, the ex-dividend date, and the payment date. So let's talk about preferred stock. Preferred stock is a type of stock that gives owner the advantage of receiving cash dividends before the common stockholders are paid any dividends. One thing about preferred stock is generally they are non-voting. So what this means is they're going to get paid either cash dividends or more stock before anyone with common stock. But keep in mind that again, dividend is not a legal obligation that the company must pay, but it must be it must be emitted by the action of the board of directors. The dollar amount of a dividend is usually known before the stock is purchased. It often is referred to again as the middle investment between common and ownership. Compared to corporate bonds, the yield is often higher, but it is a little more risky. And it does lack growth potential that common stocks offer, but it is more of a safety net for you. When you're looking to evaluate a stock issue, these are the 10 classifications for stock investment that are generally used by financial planners and stockbroker, and it just breaks it down of what type of stock it is and what kind of characteristics of the type of investment. So this would be something good for you to look at when you are determining what type of bond or stock rather that you would like to buy. The next two slides just give you some information about where you can find information on stocks and investing. And first of all, the website is of the corporation is probably your most reliable place that you can go and look. You can also go on to Yahoo. Again, the professional advisory are these three that you could look at. Print sources, the Wall Street Journal, and the Wall Street Journal, of course, is online, so you could subscribe to it. Here are some of the other online sources that you can always look at. The main thing I can advise is do your research.
Good morning, and welcome to Basic Chart Reading, Lesson Number 1. This course is going to be designed with the very beginner in mind, so we're going to be looking at a lot of terms that may be unfamiliar to you. We're going to be looking at a lot of charts over the next couple of weeks, and the whole course is designed so that you can build upon your knowledge one step at a time. Now, this very first lesson is going to be really super basic. It's just to show you what a basic chart looks like and how it functions. The very first thing you're going to see is up here is going to be your stock symbol. Then you're going to have the company name, then which board it is listed on. This is listed on the NASDAQ. Now this chart is from stockcharts.com, and up here we have the price label, this little guy right here. It's telling you what day of the week it is, what the date is, and what time it is when you open this chart. The next thing it's going to give you is the open, the high, the low, and what price the stock closed at the day before. So it closed at $14.16. It opened at $14.28. The low for the day is $14.28. And the high that it's traded at so far is $14.50. Now the bid size is going to show you what a person wants to pay for this stock. They want to pay $14.31, and the bid size is going to show you how much they want. They want 100. You always have to take this number and times it by 100. Then the ask size, that's a person who's selling the stock. This is what they want to pay. They want to get $14.31 for their stock, and then the size, of course, is going to be 2,100. Okay, now the price per earnings ratio, basically that tells you how effective a company is at managing their finances. The way that you use this number is you take the price that the stock last traded at, which is right here at 14.31. You divide this number into this number, and it gives you the EPS, which is in earnings per share. So basically this stock is a very good pick if you were going to take this one for a long-term investment. Now the last right here tells you what the last trade was, and that was 200 shares, and it traded at the 14.31 price. And then this over here, okay, the volume weighted average price, which is the total number of shares that traded hands and the average of those shares. So it would be about 14.40 for the day right now. During the last trade, the price rose 1.06%. The change is actually 15 cents right now. And of course, our last trade is 14.31, and the total number of shares that have traded hands today by 10 a.m. was 1,390,954. And that's your very basic definitions of all of these terms here. Each one can have an impact on your trade for the day. It's always a good idea to keep your eye on what's going on with your price labels. And we will take a look now at the basic chart setup itself. When you first open up your stock chart, you're going to see lots of little squiggly lines here and some strange lines here in the middle, and then something called a MACD down at the bottom with more squiggly lines. Now I'm not going to go into what each one of these indicators means just yet. I'm going to just explain this basic chart setup to you. The RSI, which is the relative strength index, tells us how powerful the stock is trading right now. When it crosses the 50 line, it's bullish, which means that people want to buy this stock. So this stock is looking good for the day. These right here are called candles, and this shows us during each trading day where the stock's price traded at, what it opened at, and what it closed at. And we'll get to that meaning a little bit later in the lessons as well. These two green lines here that surround the candles are called Bollinger Bands, and the line in the middle is the 20-day moving average for this particular setup. You can always change that, but for today we're going to go with the basic setup. We also have two bigger moving averages. Now, a moving average is calculated from a certain period of time, and for the 20-day moving average, it takes the price over 20 days and averages it out, and that's what creates this line here in the middle. The 50-day moving average is this blue line right here, and that again, of course, is the average price over a 50-day period. And then the 200-day moving average, which of course is the average of the price calculated over 200 days. This stock is obviously a well-established stock and has a well-established 200-day line. Now, all of these pretty little colors here, this is your volume, and as you can see right here, this is the volume for the very beginning of the trading day. And then this right here, the MACD, the moving average convergence and divergence. So what we want to know is, out of our moving averages, where are they converging and where they're diverging from. The first line, this black line right here, is going to be your main line. It's going to be the bullish indicator. The red line right here is going to be your bearish indicator. And these little blue bars right here represent the divergence. And as you can see right here, we have a crossover. This stock is just going in to a bullish crossover, and once it crosses the divergence line, this stock is really going to take off. So that is your very basic setup of a chart and what kind of information you can get from it. And for our next lesson, we'll go deeper into looking at the indicators and how all of these different indicators and the information that's displayed on this page can make you a better trader. Okay, thank you. Have a wonderful day.
The next two slides just show you an example of what a screen would look like if you were looking for some stock prices online. This one is through finance@yahoo, and here's Boeing. And also, if this is the one it went to, but you could do the stock symbol and it would take you directly to that particular company that you were looking at. But it gives you the last traded, what it previously closed at, and all the other information that you might want to know concerning a stock. This one is just a common stock price quote, and it's still with the Boeing company and showing what it was quoted at, how much it had gone up. Then it also gives you the latest trade price, the annual dividends, how much it's earning per share. It kind of gives you a graph over here that you can look at, and then whether you want to add it to your portfolio. Again, make sure that you do some research when you're looking at purchasing stock. Stock advisory services, they're more detailed compared to other information, but they do charge a fee. The three most popular, of course, are these three. Prospectus list all the necessary information if you're looking under corporate news. All publicly traded corporations send your stockholders an annual report. Another thing you can do is you can go to the Securities and Exchange Commission at this website, and they can give you some information. Also, there's periodicals, Bloomberg, Business Week, anything like that, that would help you be able to analyze the stock and the corporate information about the company you're considering investing in. Many analysts believe that the corporation's ability or inability to generate earnings in the future is probably one of the most significant factors in the changes in the value of the stock. What that simply means is that the higher earnings generally equate to higher stock values, but also it means the reverse is true. So if the corporation's earnings decline, generally the stock values are going to decline. So it's a reflection of the health of the firm. Now, to help evaluate a stock issue, you need to calculate two important measures. First of all is the earnings per share, and what that is the corporation's earnings are divided by the number of shares outstanding of a firm's common stock. So an EPS increase equals generally a healthy sign for a company that you're looking at. The next one is the price earning ratio, and that is where the price per share of stock is divided by the corporation's earning per share. So that just kind of gives you how you could look at the PE, the price earning, and it's always compared to firms in the same industry. You want to make sure that you're looking at that. So you want to look at the projected earnings, the EPS and the PE, that's based on historical data. And if you'll go back to that video I showed you earlier, that'll help you look at that. And then that way your future expectations of your stock are more relevant. Along with the earnings per share and the price earnings ratio, you can also look at your dividend yield and your total return. A dividend yield is the corporation's annual dividend amount divided by the current price per share for one share of stock. If their dividend yield is increased, then that's a healthy sign. A total return calculation includes not only your yearly dollar amount of dividends, but also any increase or decrease in the original price of the investment. And then you can look at the book value per share. That's assets minus liabilities divided by the number of shares. The market price per share is often greater than the book value, so you want to look at that. Finally, you want to look at these other three factors that might influence the price of a stock: beta, the price an investor's willing to pay, that and how it's determined, and then more importantly to me is the stock market bubble, and that's when stocks are trading above their actual worth, and one day the bubble is going to burst. So look at these three when you're considering your stocks. To purchase common or preferred stock, you generally are going to have to work through a brokerage firm. In turn, then the brokerage firm must buy the stock in either the primary market or a secondary market. So let's talk about the primary market. The primary market is a market in which an investor purchases financial securities, generally through an investment bank or other representative, from the issuer of the securities. An investment bank is a financial firm that assists corporations by raising funds, generally helping sell new security issues, which is considered underwriting. IPO is the initial public offering, and that occurs when a corporation sells stock to the general public for the first time. A couple of years ago, Google went public, so they had an IPO where you could buy a stock for the first time through them. A key factor that you want to consider is cash from the security sales goes to the issuing company. When you purchase stock in the secondary market, the transaction is completed on a securities exchange or through an over-the-counter market, and it's traded among investors via brokers and dealers, but the issuing company gets no cash from that trade. Some of the markets include a security exchange, and that's where member brokers who are representing investors meet to buy and sell securities. The New York Stock Exchange, which you're always going to see with the acronym NYSE, is of course one of the largest security exchanges in the world. An over-the-counter market is a network of dealers who buy and sell securities of corporation, and they're not listed on the security exchange. Most over-counter securities are traded through NASDAQ, and it's an electronic market for 3,330, about 3,300 different corporations. Every night on the nightly news, they give you the New York Stock Exchange, and they also give you the NASDAQ, whether there's been an increase or a decrease in those. This is just to showing you an example of the New York Stock Exchange. And this slide is just showing you the over-the-counter of NASDAQ. So now let's talk about a brokerage firm and an account executive. An account executive is known as a stockbroker, and he is a licensed individual who buys or sells security for you or their own clients. Now, before you choose an account executive, make sure you know your financial objectives, and make sure that you are involved in your investment program. One thing is you want to avoid letting your stockbroker use their discretion with regard to your account. Watch for signs of churning. Churning is excessive buying and selling of securities in order to generate commissions. It is illegal under SEC regulations, but if you're actively involved, you would see that show up on your weekly or monthly chart. Today, there's a healthy competition between full-service, discount, and online brokerages. So when you're deciding which you're going to use, you need to look at these questions here and answer them. The next video that I'm showing you is a great little video I found online that's talking about using a full service, a broker, or even doing it online. And it will answer many of the questions here that you may see.
Hey, this is Jeff Rose. Welcome to GoodFinancialSense.com. A lot of times, if you've been doing something for a while, you tend to take things for granted. And I got a call from a prospective client, someone I've known for several years, and they called me to ask me a question that I just thought everybody knew. And it was such a basic question when it comes to my profession that like I said, I just kind of took it for granted and just thought that everybody knew how to do it. And the question was, how do I buy stock? How do I invest into stocks? And I thought, really? Like, you don't know the answer? And like I said, it's just something that I just assumed everybody knew. So I thought I would take a minute and just address some of the different ways that if you are interested in buying stocks, you can. And to kind of give you some background on the person that called, they were in a 401k, so they were investing for their retirement, but they never actually had gone out to invest into individual stocks. And there was a certain stock that they were hot on and thought that they could make some money on, so they wanted to go buy it. So then I gave her a few different areas, a few different places that she could go to do her own research and then buy the stock. So first, if you're looking to buy stocks, make sure that you've got a foundation set. I always hate it when people call me and they want to start investing in individual stocks, and yet they don't have anything saved in retirement. They don't have a 401k, they don't have an IRA, they don't have anything. They don't have an emergency fund, and yet they want to start investing and playing in the stock market. That's one of my biggest pet peeves, because it's kind of like a house, right? With a house, you've got to build a foundation first. You don't start putting on the roof or start doing some of the inner accessories like the big screen TV and the couches before you have the framework done, the foundation done. So make sure you have those in place first before you go out and start buying stocks. That's my little entry disclaimer, but just want to get that out there first. Okay, now if you're ready to start buying stocks and you feel comfortable doing this, you have a couple of different areas online you can go to. The first place that you can go is any discount broker. Think your E-Trade, your Share Builders, your Zecco, your Trade King, and I'm sure there are countless others. But these places are good. One, they're very, very inexpensive. Sometimes you can open accounts for free. And then to execute the trade, to actually buy the stock, you may pay as little as $7.95 on up to $15 per trade. And that's pretty reasonable, especially if you're only going to be doing a few trades here and there. Some of them, I'm not familiar with all the rules, but they may charge you an annual fee if you don't do a lot of trading. Definitely read all the fine print and rules before you engage on this. But if it's something that you're going to be buying, a few stock here and there, that could be a viable option. Another option, if you're comfortable making the purchases online, is to actually buy it directly through the company itself. And one website that has a lot of arrangements with a lot of different companies is ComputerShare. A lot of times when I have clients that have a share of stock that they either inherited or it was given to them, a lot of times ComputerShare.com is the custodian. So they'll have to call them to liquidate it or to find out how many shares they own. ComputerShare just seems to be a common hub for a lot of these different companies. How I've recently had some more relationship with ComputerShare was that I wanted to buy stock for my kids. Not so much as an investment, but more of kind of a keepsake, where I wanted to buy a share, put my son's name on it as in the form of a custodial account, to where they had the actual certificate, something we could frame and put on the wall, and just kind of have some kind of a keepsake. And I was having difficulty trying to find the certain stock that I wanted to buy. And sure enough, I went through ComputerShare and they had an arrangement with that company. So I'll be doing that here soon. So ComputerShare has a relationship with a lot of those companies. And you can go to ComputerShare.com and follow their links. I link you go to Investor Center. And then from there, you can see some of the companies that they have an arrangement for. And I think it's over 500 companies. You have to check the website just to double check. But that's another venue that you can go. I think it's maybe a $15 transaction charge. So once again, very minimal cost to do it. But it's another good do-it-yourself online arena where you can go to buy individual stocks. Okay, If you still want to buy stocks, you're not completely comfortable going online to do it, I don't blame you. That can be intimidating for a lot of people, open up an account online, send some money to some faceless operation. The other option you have is you could probably go to a local investment house, local stockbroker, and to buy stock through them. Just so you know, by going that direction, you're probably going to pay more, considerably more, but at least you have a face of someone you can talk to, someone that can, maybe share their expertise of what you think is going to make you a lot of money if it really is. And then also too, you have somebody that hopefully is going to educate you on having that foundation set. All the different brokerage firms, they all differ on their prices. But I have to think at minimum you're going to be spending about $40 per transaction. So if you buy a certain number of shares, it's $40. If you sell again, it's another $40. And that's for a smaller amount transaction. The higher transaction you go, the more shares you buy, or the higher that the share price is, will then also determine how much your commission is going to be. And then some of these firms now as well, if you don't trade frequently, they're going to hit you with either a small account fee or an inactivity fee. So be conscious of that. It's definitely not the cheapest direction to go. And typically when I'm working with clients and if they want to do some stock trades or they have maybe a younger relative or their kid that wants to buy shares of stock and that's all they want to do, I usually will guide them to one of these online platforms if they're comfortable, just to help save them a few bucks. So those are some of the different options you have. If you want to buy stock, you can go online to either one of the online discount brokers or go to computershare.com. And if you're not comfortable, head to your local brokerage. And then, kind of like when you shop around, I would maybe interview one or two different brokers just to kind of see what would be the potential cost, to doing so. I would just say, hey, how much would it cost to buy 100 shares of, and just give them some stock, maybe the stock you're interested in, just to see, what it is and how much the fee is going to be. Because you want to make sure you know what you're getting yourself into. Make sure you read the fine print before you proceed and make that initial investment. If you have other questions about anything similar to this, you know where to find me, goodfinancialsense.com. I've got tons of information there. And also be sure to check us out on Facebook at the Good Financial Sense Facebook fan page. Thanks again, and we'll be talking to you soon.
You can also trade again online or computerized, and here's just some reasons that people do justify trading online. Is the ability, first of all, to manage your own portfolio, but remember it does take time, so you can't just every now and then go in and check your portfolio. It's something you're going to have to do quite frequently. You also need to know some terminology for stock transaction orders. And the market order is the order to buy or sell stocks at the current value. The limit order is to buy or sell stocks at a specified price. And the stop loss order is an order to sell stocks at the next available opportunity after its market price reaches a specific amount. Now, before you begin investing real money, you might want to just kind of set up a practice, and you can use an internet search engine to find a stock investment simulation. This will help you feel more confident when you start to use your own money. This is just showing you some commission charges. Its minimum commission can range from 5 to 25. Full service, they are going to charge you a full service fee, or maybe even a broker fee. Online broker, you have little advice and you make your own decisions. The next two slides are talking about long-term investment strategies. And of course, we want to buy and hold so that we're, adding to our portfolio. We want to look at our dollar cost averaging. The next slide will show you how to look at that. And then DRIPs is called direct investment and dividend reinvestment plans, which means they go directly back into your buying more stock. And here's some websites that you can look at for those. Also, the dollar Cost averaging shows you how to look at a long-term technique by investing equal dollar amounts in the same stock at intervals. Now, right here is what you want to avoid: buy high, sell low. You always want to buy low, sell high. The DRIPS is the direct investment plan, and it allows the purchase of stock directly from the company where you have no broker or a stock market account executive, and it allows for options of reinvesting dividends into the company to purchase more stock. This is what most people, the DRIPS is what most people are going to do, is they're going to just keep buying stock unless you see that your stock is fluctuating. These next 3 slides are talking about some short-term investment strategies, buying stock on margin and selling short. I have embedded 2 videos that will explain these more in detail. This is something I've never done, so it's a little over my head. So I've got these 2 great videos that'll help explain them to you. Finally, let's talk about your trading in options. An option gives you as the investor the right to buy or sell stock at a predetermined price during a specified period of time. There's 2 ways you can do this. The call option is sold by the stockbroker, and it gives the purchaser the right to buy a certain amount of stocks at a guaranteed price, and that's called bullish. Or you have the put option, which is the right to sell 100 shares of stock at a guaranteed price before a specified expiration date, and that's called bearish. And then notice, please, it says this is not for amateurs or beginning investors, which I would assume most of you would be beginning investors. So that concludes chapter 12 on investing in stocks.